Need fast capital for your real estate investment deal? Full Cycle Funding delivers. With over 20 years in real estate investing, we understand your needs. Get funded quickly, get funded reliably. That's Full Cycle Funding, your trusted hard money lender. Visit www.fullcyclefunding.com today. On today's episode of the Burn Your Boats Wealth podcast,
we welcome Walker Deibel, well-known author of Buy Then Build.
David, thanks so much for having me.
Yeah, it's an exciting time for us, Walker. We've dropped your name an uncomfortable amount of times on the podcast. How did you come to write one of the most important business books out there?
David, I want to say like this. It all goes back to...
I'm listening intently because you're laying the groundwork. I love it. Keep going. I need to name drop a little bit here, Walker, but Cody Sanchez and Alex Hermosi would not be known today had you not written this book. I'm sure of it. You know, you wrote the book. They're making it sexy, right? But
I'm actually launching that service right now on this podcast.
That's
it's a membership.
Man.
It's only
we got an announcement, Walker.
Yeah, it's only $9.99 a month. Yeah.
Yeah.
But there's a lot of assumptions in there. Like, I'm assuming it has a kitchen. I'm you know, I sort of like to call it I Mr. Miyagi their ass. I get.
What kind of people do well after they buy the business?
Oh, interesting.
After they buy.
Someone said to me, like, what's the first thing you do after, this was last week. They said, what's the first thing you do after you buy a business? And I said, they're sort of like, you know, doing the buy then chill version.
This is what we were talking about, Walker. This is why you don't script out these episodes very much. It keeps you too much in a box.
Actually, can you imagine if buy then build was? So what I haven't shared this yet. I'll say it right now, that my number one...
Like many of you, I am a product of the pre and early internet age where there was very little information available to young, aspiring entrepreneurs. Where our guest today, Walker Deibel, literally wrote the book on business acquisition and scaling those businesses and selling those businesses after acquisition. Walker wrote this book over a 12-year period, doing the acquisition and scratching his head and marveling at the fact that there was simply no information available out there. People like Cody Sanchez, Alex Hermosi will directly attribute their success to our guest today, Walker Deibel. It is our honor to have him on the podcast today. It's an honor to call him my friend. And so without further ado, please let's welcome Walker Deibel to our show today. All right, everybody, welcome to a really exciting episode of the Burn Your Boats Wealth podcast. I've got a guest today. Quite frankly, I haven't been this excited to bring on a guest since we started the podcast. So with that being said, we welcome Walker Deibel, well-known author of Buy Then Build. And for anybody who doesn't know what that is, it is the Rich Dad, Poor Dad book of the business acquisition world. So if you have listened to podcasts where people say, well, what's the book that you started? How did you start in real estate? Well, I picked up Rich Dad, Poor Dad. Well, Walker, I think the same can be said about the hundreds of thousands of people who've read your book and you've impacted and grown their wealth through Buy Then Build. Walker, welcome to the show.
David, thanks so much for having me. What a kind introduction. I'm super excited to be here. And I really enjoyed spending a few days in Colorado getting to know you. So thanks for the invite. Super pumped.
Yeah, it's an exciting time for us, Walker, we've dropped your name an uncomfortable amount of times on the podcast, so to have you here is a genuine honor. And actually, to your point about meeting you, you're just the most solid, ordinary, funny ass person that you're going to meet on a day-to-day basis as well. So we're going to have a lot of fun here today. We won't grind out a boring episode here. We'll have fun with it. And with that being said, how's your wrists after your speeding down the hills of Breckenridge?
Yeah, so David and I went skiing, and I'm kind of wired for high risk. And when I hadn't been skiing in about 20 years, and we were just going down for lunch. I'd had a great morning, no spills, and I was like, I'm just gonna bomb it out. And David, I was probably going near 14 miles an hour, and I took a spill, and I just sort of hit my wrist, and it looked like my thumb was broken. I mean, we all sort of were staring at it, going, "Yeah, it looks broken," but I've done nothing. I wore a brace for a while, and it's still a bit sore. I was thinking that this morning, but I don't shake people's hands at the moment. I just fist bump, because it's like it's right in here.
It's very
smart. People already are turning this off. They're like, this guy is so dumb. Like, you need his hand. He's got to go to a doctor, But, I called the doctor in an Uber, and they were like, what's your insurance? And I'm like, I don't know. I'm in an Uber. It's in the trunk. Like, can we just schedule? And she was like, no, call me back. And I called her back, and it's a voicemail. And I'm just like, whatever. I don't have time for this. So,
Yeah.
Let's go. Yeah, right.
I'm tougher than this.
Right. Yeah, exactly.
Walker, how did it come about? How did you come to write one of the most important business books out there?
So I think, look, David, I want to say like this. It all goes back to, imagine, remember 1999 to sort of like 2004, right? This was a key time for me. I graduated college. I had my first job as, a stockbroker. I lived in the Bay Area for a while. Like, entrepreneurship was defined by Silicon Valley, right?
Yeah.
And a lot of these big accelerators were coming out countrywide at that time, and everyone was sort of trying to teach what was happening in Silicon Valley and just copy and paste it. And, and MBA classes started teaching entrepreneurship right there around like 2000, 2001, 2002. And, I got my MBA in 2002 to 2004. I kind of used that time as a bit of a resume shield to try to start my own business, right? We did that, and, it failed, which is just sort of what happens when you start companies, even though we were doing great, and then it doesn't work out. And, I'd sort of lightly tried to start a business before that, and, so on and so forth. And ultimately, in 2004, I was walking up and down Wydown Boulevard. So St. Louis has one boulevard, and it's sort of, but Mary's like WashU or Forest Park to downtown Clayton. And there's a lot of joggers and, bike riders and whatever. I was walking with my friend, and I was looking around at these kind of like huge mansions. And like, this is Clayton, Missouri, and it's right next door to Ladue, Missouri. And Ladue is one of the top 10 richest neighborhoods in like the country, if not the world. I don't know. It's really rich. And it's in like, I'm walking around and I'm like, I'm to my friend Kevin, I'm like, none of these people were like tech entrepreneurs. Like, what were they doing? What were they doing? And so, they all, like, if you're in the Midwest, like, it goes all the way back to like the fur trade and like Listerine and like the fuse and like rowboats, and so it's a lot of like paper distribution. I met a guy who owned the piece inside the can light, like the can part of the light. He makes those. And I was just like, he was so comfortable, and I was just like, okay, what's going on here? So I was like, how do I, like, no one's gonna start one of these old economy businesses that that are just stable and cash flowing and not growing. This is a terrible idea. So it just became to me like, well, I know there's a way to sort of acquire one of these companies. Like, how do I do that? And I just kind of went that direction, and I quickly figured out that there was no information whatsoever on this whole space. And like, I'm talking to my MBA professors, they're trying to talk me out of it. They're like, Walker, this is a terrible idea. And search funds were just starting to like come out of, Cambridge, Mass, and it's sort of coming out of Stanford at that time. And I was imagining walking around St. Louis asking people for money to go buy a business. And I'm just like, this is not going to work, and like, this is not like, I'm not going to be met with open arms on this one. So I was like, okay, I think that like there's all of this bad information. It was like subjective information. It was opaque. It was fragmented. And like, I was talking to everyone, and everyone had a different piece of information, a different read on what was happening. And I was like, this is like an entire capital market that looks really, really boring, that has like immense amounts of cash pushing out of it. And it's not even like positive economically at the GDP level, because you have all these baby boomers driving around in their Lexuses, and they've already put all their kids through college, and they're like, I don't want to take on any debt. We're just milking this thing. It was literally an empire of cash cows, right? Just sleepy, invisible cash cows. And I was like, okay, so I got the idea in 2004 to write Buy Then Build. Okay. And I thought about writing it, and then I realized a couple of things. One, I hadn't done it. So had I written the book, it would have been like the intern interviewing people that had done it, and it would look really good on like my resume when
Fake it till you make it.
Yeah, when I was like 30, it'd be like, oh, you wrote a book? Like, wow, that's impressive. But it would, you'd sell like 500 copies at most, or whatever books actually do. And I was like, if I ever write this book, it's like I need to really write it from experience, and I need to define the space. And anything short of that, I'm just not going to do it. So basically, by the time I got to, 2013, I had owned my first company for 7 years. I had sold it to a strategic target that I was trying to acquire. And then I started another company that didn't work out, because that's what happens. And then I went out and I bought more companies, and I was hanging out, like I was in the entrepreneurship circle, and I just kept being introduced as, this is Walker, he buys and sells companies. And it just, David, it really got under my skin, because I was like, you guys don't understand. Like, I'm not like a banker buying and selling companies. I'm an entrepreneur just like you. Yeah. It's just that like I don't have some sexy app with no revenue. My revenue is like revenue is like 20 times yours, and I'm cash flowing like 7 figures on the bottom line, and it looks really, really boring to you on the outside, really, really unsexy, right? But like, I am in the Coliseum just like you. Yeah. I am fighting every day for a new client just like you. I am managing cash just like you. I'm doing capital allocation. I'm managing employees. I'm hiring. I'm firing. I'm leading. I'm doing all of the same things. And it's like, the analogy was like, all of real estate investing was defined only as ground up construction for like decades. And I'm just like, there's this little thing called value add, where like you buy an existing property and like rehab it. And like everyone's like their minds are blown, and I'm like, stop, like the sexier it is, the more broke you are. Okay. Yeah, and like the more unsexy it is, the more it's going to cash flow. Right. And so I just sort of figured that out. So, frankly, I had the idea early on. Second, I started getting really angry, because all of my friends, I was like, they would buy companies if they understood what I was doing. Right. They wouldn't be trying to recreate the wheel. Yeah. And they didn't understand the baby boomers like were retiring. Like I knew this. And like,
you just knew it. It was just in your system.
No. In 2010, like I knew that there was $10 trillion that was going to be sold by baby boomers by 2030. Yeah. Like I saw it happening. I was like, this is going to be huge. And and again, like my professors were just like, this is so dumb, Walker. Like it was just so contrarian. It was so contrarian that it was so hard to come up with it. And I essentially wrote Buy Then Build partially to make it make sense for myself, partially to explain to my other entrepreneur friends that there was another way, partially because by that time I had done it so many times, and partially in 2016 on January 1st, the SBA for the first time ever changed a little rule. And the little rule was, hey, Walker, do you remember that first business that you bought, which was like a $8 million book printing company? And the only reason you could buy it was because it had all of this equipment in it, because you didn't have any money or any collateral, and like you needed this big thing. And so there were these like SaaS companies that were just like so awesome, cranking, but like I can't touch it. But like I could buy a book printing company because the bank loved it, and they were selling for low multiples. And I'm like, great. And so that's what I bought. But in 2016, they were like, look, as long as you sign a personal guarantee, I don't care if you have collateral. I don't care if the business has collateral. And all of a sudden, service businesses became completely unlocked. Like, so I bought four companies that year. And it was like, no one knows what's happening right now. Like, it was just crazy. So, so that was the thing. And then ultimately it took me a long time to write it. It really took me like 4.5 years to write it. But 2016 was when I really was like, I got to get this out. And then October 2018 is when it got published, but I sat on it for 9 months after even my publishers said it was done. Like, they're like, it's done. I'm like, not yet. And I still I rewrote 2 more chapters. I'm like, all right, now it's done. I waited 9 months because I was like, someone's gonna read this and like all of my faulty logic is in black and white. Like
Yeah.
you know,
Yeah.
or
Forever.
yeah, or right, or someone's gonna read it and get all excited and buy a business, and that's fucking crazy.
Yeah, right.
Right? Like that's
Yeah.
crazy. Like, am I just like hardwired for risk somehow in a way that what if someone does this? Like it's crazy. And then I realized a couple of things. One, every single book ever written on entrepreneurship is like, yo, dog, quit your job, leave the walled palace, take no supplies with you, and just like start a business from scratch and give all your equity away.
Yeah.
And I'm just like, that is also crazy. And then you got Rich Dad, Poor Dad, which is like, yo, dog, like, you know, take all these PGs on, you know, real estate assets, you know, and run it on the side until you can replace your paycheck and then quit. And then one day you can, you know, buy as big like I am or what, you know, whatever. So it's just like every other thing out there. It's like every single, you know, force has a light and a dark side, right?
Yeah.
And it's just sort of like there will be an undercurrent. There will be broken eggs. There will be mistakes that happen. But ultimately, everyone needs to know what's happening right now because it's amazing. And I'm like this young man in St. Louis who apparently is the only person that knows about this entire capital market.
Well, you know what?
That's the story,
Walker,
David. Sorry, yeah.
Walker, do you remember back when they had like the DVD commentary where people like the actors would talk about their shows? I feel like
Awesome.
you need to be that guy for the yo dog. This is what I mean on Rich Dad Poor Dad. We need the DVD extras, man. I need you to just go review like a bunch of different books. I would pay for that before I'd buy the book. I'm like, I don't care about what Kiyosaki says. Just give me the
That's
yo
so
dog
funny.
version.
That's great. I'm actually launching that service right now on this podcast.
That's
it's a
it,
membership.
man.
It's
Oh,
only
we got an announcement, Walker.
Yeah, it's only $9.99 a month. Yeah. Reach out to David and Clark.
I love it, man. You're getting it started right out of the gate.
Ready to go all in on your financial future? Join the Burn Your Boats Wealth Investor community. Get your free investor kit, new episode alerts, and even a 15-minute call with hosts Clark Lunt and David Shaw. Stop waiting. Start building wealth today. Visit burnyourboatswealth.com now.
Walker, I've heard Buy Then Build was a 14-year project, right? And everyone just sees the 2018, 2000, you know, it's the biggest book. And it's like, that's all they see. They don't see the 14 years behind it of like tears and blood and sweat and everything. I'm curious, how many people were punching you in the face saying, your professors, they were like, this is a horrible idea. Like how long did it take before people stopped saying you're crazy and they're like, hold on, tell me more. What are you talking about?
It was all about finding the market, right? You know, going back, like, I think just so many people just are safe or have like, I mean, that's why it's contrarian, right? You know what I'm saying? Like, I think that to your point, let me start here. You know, people read Buy Then Build and they're like, great, this is amazing, right? But the truth is like, I have millions of dollars and over a decade of experience and multiples of my net worth and personally guaranteed debt and like staring really hard things in the face and like big entrepreneur challenges that I thought were going to wipe me out. But it also led to making 7 figures a few times over. You know, so it's like, I believe I say it in the book, is like doing acquisition entrepreneurship is actually the most engaged life possible, right? And I think people translate that accidentally to like it's the best life. And I just mean it's like you're getting out of the Matrix and all of a sudden like now you're Neo and you have to actually fight the real life beasts, not the imaginary beasts, you know, of like your day job or whatever it is. Like there's a whole nother thing that going on. And when you take on the debt to buy these companies, you know, I think that the way that I always thought about it was, well, this is all these startups are giving away their equity. And like the whole reason you do it is for the equity, right? So it's like, I'm the only thing I have is this equity. And then whenever the businesses don't go well, and I've been in a lot of these rooms, the entrepreneurs are like, all right, guys, like we got like, you know, 90 days of burn rate left, like start looking for jobs. And it's like, well, why don't we all just give the money back that's left? But it's, you know, because it's like if we already have given up, like just give the money back. Like this is where we are, right? But you don't. You sort of act, right? Like it's still going and you're spinning the plates and saying the things. And then you're like, yeah, it didn't work out. Thanks for investing in me. And it's like, to me, that was silly. And it was like, okay, so when you take the debt, it's like you are writing the check that day. You owe that money, right? And in exchange, you get 100% of the equity of this business. So it's 100% upside to you. And as you pay down that debt, you get that equity buildup, right? So you have these real estate economics all of a sudden at play. When I sold my first business for 7 figures, I actually sold it for, like, I owned it during the Great Recession. It was like a terrible time, okay? Terrible. We were like furloughing people. I had to lay off like 10, 20% of my employees. It was so hard. It was a book printing company, and a year after I bought it, the Kindle came out. And a year after that, the iPad came out. And then bookstores were going out of business, and the newspapers were trying to take our customers as they were going under. It was terrible. I sold it for like almost exactly the same for what I bought it for. The month after, I paid off all the debt. And that was my first 7-figure exit. And I was like, oh my God. Right? It was like this light bulb moment. It was like, imagine if you actually add building to this.
Because that's what people are here for. That's the meat and potatoes right there. You buy this business. When you buy a building, it has, in general, about a 25-year runway to pay itself off, more or less, right?
Sure. Yeah.
When you buy a business, you generally will buy it with anywhere from 2 times EBITDA up to maybe 9 or 10 times for a really big business. But on average, 4 to 6.
I'd say 2 to 3. 2.5 to 4x SDE.
Okay.
That's SDE, not EBITDA. Because there's adjusted EBITDA, all these different things. Revenue.
Let's clarify the terms so that we can talk about them for the rest of the show.
Yeah, thanks. So SDE is seller's discretionary earnings. And the concept here is, for those familiar with EBITDA, it's a step beyond that, in that it's saying, like, if I own this black box that is this business, how much money is this black box giving out that I, as the owner of this black box, can use discretionarily? So I can take it out as salary, I can reinvest it in the business, and I can pay down principal and interest. Okay, so it's all of the cash flow that this black box is generating as the owner operator.
After taxes, after everything, right? So that's why I prefer SDE than anything else, because it's actually the cash flow. It's what real estate investors would understand as being the net cash flow.
Whether you're using SDE or adjusted EBITDA or EBITDA really just depends on which market you're playing in. So SDE really defines the sort of Main Street market. And that's definitely a sub $5 million acquisition, which, by the way, is like 99% of all acquisitions. And then you've got up to definitely about, I would say the top range would be 25 million. But really north of 20 million, you're not going to see, SDE used anymore. It switches to adjusted EBITDA. And then
I understand that.
Okay.
Then we're into more corporate acquisitions and stuff.
Yeah, so let's use SDE, but let's keep in mind we're probably talking about the sub $10 million acquisition space.
SDE, seller discretionary income. How much money, when all is said and done, does the seller get to play with? Did he get it, take it home? He can invest it in the business. He can pay off his loan. He can do whatever, or she can do whatever they want. Right.
The buyer.
So when you're buying the business, you're going to buy it anywhere between 2, 4, 6 times that number. I've just told you, with a building, you're buying it with probably a 25-year runway.
Yeah.
With a business, you're buying it with what, Walker?
The loan will amortize over 10, right? So 10 years.
But more often than not, these buyers, these acquisition entrepreneurs will pay that debt off at an accelerated rate because businesses throw off more money. Yes or no?
Maybe. I think no. I think that in theory it feels like you're going to, but you never do. I mean, so the reason why I was able to pay off that first loan in 7 years was because it was a traditional commercial loan. So it was a 7-year amort. That's the only reason it was paid off, and it was heavy.
Got it.
It was expensive. I paid myself $0 one year. And it wasn't because I was like Steve Jobs getting like $1 billion in stock over here on the side. It literally was like, I'm just paying the debt. And I didn't have enough money to not make any money that year. It's just, there's no other choice. So, Jim Collins, the second best author of all time, Jim Collins, he's a climber. Thanks, Clark.
Jim.
Yeah, he's a climber, and so he likes to say, or I've heard him say, I should say, that if you are staring up at like this just hugely intimidating climb that's harder than anything you've ever done before, but there's a nice little path back to your car. Guess what? You go back to your car. But if there is no other way out and you have to climb it, what do? You climb it. That's acquisition entrepreneurship, right? That's what happened. And so anyway, just to pull it back. So that was a 7-year loan. It was a very heavy principal and interest payment, but normally it's 10 years. And here's what I'm going to say is like it cash flows heavily compared to what you paid for it when compared to real estate. And right now I see a lot of real estate investors moving into businesses. And I think there's 2 reasons behind this. Okay. The first is that like, we see it over and over again. Okay, with like stock pickers and index funds, right? They're like, okay, I cover, growth stocks in this, middle size segment. And then all of a sudden, growth mid-market, middle size stocks start underperforming. So when the guy across the hall who does the, large cap, stable stocks, like he'll walk over there when he goes to lunch and look at what he's buying, and he'll buy some of that in his fund, right? And it's like, well, now I'm going to go buy that. So there's a scope creep there. Now, the same thing's happening in real estate. One, the last like probably 2-3 years has been like the hardest time to raise money in real estate since like the Great Recession. Yeah. And so all these people that like this was what they did, they're all of a sudden having a really hard time. 2, they think in terms of cap rate. And so they'll look at like, okay, I'm going to buy this building for, maybe on the high end, 10% cap rate, 6% cap rate, whatever it is. And so cap rate would be I pay 100% and I get, 6% in cash every year. And that's like my revenue. And then they look at businesses and they're like, what the hell? This is, if they think in terms of cap rate, they're like, this is like a 25 to 33% cap rate.
That's right.
But you need to understand that I'm seeing a lot of real estate lessons being pulled into this asset class, and it's, I believe, incorrect. For example, let me just throw one right down the chute, which is you make money when you buy. Not in this space. Not in this space. You make money when you sell, right? Like the appreciation on a building is predetermined. It's like 2% a year plus or minus 1%. All you have is the equity buildup, right? That's it. And like you have a hard asset that no matter what happens is always going to be worth something. Okay. It's a real asset. It's called real estate. Okay. In businesses, the value is actually completely intangible. Even when it looks like it's tangible, it's not. It's people, it's processes, it's SOPs, it's customers, it's the way we do things, it's how we deliver, it's leadership, it's all of the things inside the animal that is making this thing move. And there's a lot more risk because it's like when you say to me, hey Walker, there is a 3-2 3,000 square foot single family home in the zip code 63105. I already have like an estimate of what that house is going to sell for because I just know the zip code, right? But there's a lot of assumptions in there. Like I'm assuming it has a kitchen. I'm assuming that there are like there's actual toilets in the bathroom. I'm assuming that like it's finished. When you buy a business, you get in there and then you're like, okay, so when I buy this, the owner is the one who plays golf with all the customers, and then like the key employee like is the kitchen. Like, is that person gonna leave? Like, there's a lot going on. Okay. Yeah. And so people like the worst email I get is like, hey man, like, should I buy this business? Dude, I get like 20 of these a week. I mean, it's just and then they throw over a business and I'm just like, I don't know who you are. I don't know what there's no way that I can begin to unpack that in like a email response, like glance at it and be like, yeah, it looks good. Like, no. There's so much going into that. Yeah.
Walker, what is interesting is that like when I start seeing real estate people sell businesses like it's a wholesale deal, to your point. And it's like, well, hold on. You know nothing about this, and you're selling it like it's a cap rate real estate deal where I can just passively hire a contractor and all will be well in the world. And so it's funny to your point, because I see that a lot with like sub 2 deals, right? Like sub 2 popped up after 2022 when interest rates started going up, and that was the flavor of the day. And you had a bunch of people that had never done a sub 2 deal. And now I'm starting to see it on message boards and groups where it's like the buyer, guess what? The taxes went up. Guess what? The insurance went up. Guess what? That zero cash flow is now negative 500. And all of a sudden it's not such a great deal anymore. And I feel like being a real estate guy, we evolved from the sub 2, that flamed out, right? That party is done. Let's go buy a business, because to your point, you can get it a 28 cap, right? Instead of a 6 cap. What do you see? Like, what's the future hold maybe in the next year or so, where a bunch of real estate guys get into it, looking at it like a real estate deal, and they're like, holy shit, this is not a wholesale deal?
Yeah, I think that, we touched on, I think there obviously will be a undercurrent. Like, when Rich Dad Poor Dad came out and, everyone and their mom ran out and bought, real estate and they're swinging hammers on the weekend or whatever, a lot of them learned some really hard lessons, and we will see that. Okay.
Yeah.
Now, what I'll say to this is it also goes into, one of the things that we try to do at Acquisition Lab, right? So ultimately, when I finally got comfortable with like, okay, I'm going to release Buy Then Build, and we're going to, go do this, and I'm really trying to write like the seminal book on this topic, right? That was the effort that I tried, right? So it wasn't on accident. Now, the thing was that I realized that my target market was like competent people. And let me explain. Like it's like middle managers at whatever organization that like want to go out on their own, but like they have a family. They're not going to just be like, yo, I'm starting a business with no product market fit. Or like, hey, I'm an engineer and I work in manufacturing, and I just realized I spent my last 25 years making that other chick rich who owns the company, right? Or like, hey, I'm going to go out and be an entrepreneur and I'm already comfortable taking that risk. But wait, look at this option. Like these were the people I was targeting. And that was very deliberate. And what happened was that by 2021, I mean, it was, what do you call it when like the trash is on fire? I mean, it's like
dumpster fire?
Yeah, dumpster fire. Yeah, I mean, it was just like, oh my God. And so at Acquisition Lab, I actually, when we built it, we launched it in 2019. Well, I launched it, frankly, by myself with cohort 1 in 2019. And then Chelsea came on for like cohort 2 in February of 2020. Like, and then COVID was announced right away. It was pretty awesome. But the thing was I said, Chelsea, here's the deal. Usually when you start in it, by the way, Acquisition Lab is our accelerator for helping people buy businesses. I read Buy Then Build. Hey, I want to go do it. Okay. But like I said to her, listen, when you start an industry, usually you just start one, and then a bunch of other people come in and it gets crowded. And then someone comes in at the end and says, oh, we're actually like the best one. And they have all these metrics. Okay.
Right.
And I said, we're actually the best one as we're starting this. And so we're going to give away a ton of revenue to people that probably shouldn't be spending any money, giving it to people that probably can't really help them. Right. And I'm just, being honest. So it's like, so it's going to feel weird. Okay. And to this day, we're now at cohort 56. We now have 1,000 members. Okay. We have a 37% conversion rate from member to actual acquisition. They bought over $500 million in small businesses. Wow. We take no kickbacks. We take no, we're not like, give me a point on this alone.
Yeah,
none of that shit. We take no equity. We don't, nothing. We don't invest in these companies. We don't do anything like, there's no weird economics. It's a one-time fee, lifetime access. Yeah. That's how we built it. Okay. Because I want people coming back when they get into the valley of the search. You already bought it. Come on back. We have, 6 speakers. I'm sorry. I'm not trying to sell Acquisition Lab. The point is that I was like, this is going to get loud. And because it's a really sexy topic to be unsexy, like, like cash flow is the new black, right? And, boring is the new black, and, so now that we have 1,000 members, we just went back and looked, we have 3,500 people that we interviewed that wanted to join, not that we were selling, that wanted to join, that we did not extend an invitation to enroll. So we're a truly vetted community, and it's the little thing that makes the big difference in terms of results. Now, Walker, what was the question that was asked? It was, are there going to be people that go out there and make mistakes? Of course. But the thing is like the way that we run it is, I sort of like to call it, I Mr. Miyagi their ass. I get them in, and and it's like if they can get in, then they can do it. We know they can do it, right? And so, but I want to try to talk them out of it. Frankly, I don't say that publicly, but I'm saying it right now. That's actually what I do. I kind of try to talk them out of it, because if you still get past, then you're like in, and I'm like, you're in. Then they're like, I want to learn karate. I'm like, paint the fence. I want to learn karate. Wax the car. I want to learn karate. Okay, you're in. Let's go kick some ass.
Love it. I'm going to start off here, right, with my next question, right? Yeah. So you write this book, right? Yeah. To Clark's point, to your point, takes 14 years to write this book. 14 years is you doing it. You're learning how to write the book, right? You get it out there. You start getting the attention and the readership from the book. You set up Acquisition Lab. Acquisition Lab, for anybody out there who's listening at this point in time, Acquisition Lab is an environment where you go and you do your training, right? You read the book, you're left with questions. Acquisition Lab is a community, a acquisition entrepreneur community where you go in, Walker reference cohorts. Cohorts are different groups that start at different times, and they go through that training as a group together, and they support each other. And by the time they're done, they will then have the knowledge, the know-how, and the platforms and the search environment to know who they are, what they're looking for, right? Because a lot of people just say, oh, I like, writing books. No. You're not in the writing books business, right? You're in a different business. So most businesses, you think what the business is, but it's something completely different. The actual business is marketing. Very few businesses are the label on the can, as we both know. And then most people start off going, I want this business or that business, not knowing what they want, who they are, what they're good at. So my question then, you got nearly 1,000 people. Think about that.
We just hit 1,000. Yeah.
That's nuts.
Nuts.
So a lot of people will come to you at a particular juncture in their life. Very few people are going to come to you when everything's going smashing at their W2. Or
there's some level of I'm stuck, or I've had a realization, or obviously it's not like I'm getting promoted 6 times this year and I'm calling Walker. Like that's not what's happening.
They come to you when there's a sense of
something.
They come to you when there's a sense of yearning for change. It didn't say it smacks of desperation.
Yeah,
but
correct.
They're coming to you when there's a sense of yearning. I need to name drop a little bit here, Walker, but Cody Sanchez and Alex Hermosi would not be known today had you not written this book. I'm sure of it. You wrote the book. They're making it sexy, right?
I met this guy. I was at MMT Mastermind Talks, and we had this little breakout session by the pool, and we're going around introducing ourselves, and the guy goes, "Oh, I know you," and I was like, "Oh, great," and he goes, "Yeah, you wrote Buy Then Build, right?" And I'm like, "Yeah," and he goes, "Do you know Alex Hermosi?" And I was like, "Yeah, I know Alex Hermosi. I mean, I don't know him personally, but I know who he is." And he was like, "So I was Alex Hermosi's college roommate," and I was like, "Whoa, dude, tell me what he was like in college." Anyway, we had a great conversation, but he said that he was reading Buy Then Build and was talking to his roommate about like, I got to figure out how to buy businesses. And when you actually look at what he's doing, that's what he's doing in the background, right? It's like, line. Yeah, it's really awesome. So yeah, I think it's really cool.
But the question is what kind of people do well after they buy the business?
Oh, interesting.
After they buy. So we know the people who read it. We know the people who go through the trainings. We know the people who join the communities. They're all excited. We did an episode of a podcast yesterday, and we were talking about this bell curve of excitement. You're doing the reading, you're meeting Walker, you're in the cohort, you're in the group. It's all lovely. You identify the business, you buy the business, you acquire the business. It's all exciting. And then, holy shit balls, I've got to run the business.
I got to tell you.
And it doesn't have a kitchen.
Yeah. So, someone said to me like, what's the first thing you do after, this was last week. They said, what's the first thing you do after you buy a business? And I said, I throw up. Right. And I was in Chicago and I met this guy who bought I can't remember what company it was, but every morning, so they close the night before and he walks in first day, and he was a recent MBA, like, maybe even like a traditional search fund style acquisition. And every day the management team meets in the conference room, and he was like, all right, guys, give me a minute. And he walked to his corner office and he's like, I went into the bathroom in my office and I shut the door and I just had like violent diarrhea. Like I was just like so nervous. I couldn't believe what happened, and he's like, so I pulled myself together. I did some deep breathing, I splashed water on my face and I walked in the conference room. And that's the minute I realized that the wall of the conference room also was the wall that bordered my bathroom. And I'm like, welcome to the club. This is exactly the right reaction.
That's good.
Exactly the right reaction, right? So I think it's a lift, right? So who does well in these types of businesses? I would say there's a lot of different combinations, David. I wish I could give you a silver bullet. And so I'm having to distill a lot of information in my head as I'm talking. And so on the one hand, look, you've got the 4 quadrants in Buy Then Build, right? The AE matrix. And it's like, eternally profitable business, turnaround, high growth, and platform company. And I mean platform company, not in the sense of how private equity refers to it, but basically a business that aligns really well with your skill and ability and what it is that you want to be doing, right?
Yeah.
Because I think what a lot of people miss is that we all sit around, and especially first-time buyers, you sit around and like you look at a business and you're reading it and like you look at the P&L and you're trying to understand the cash flow and all these other things. But the first thing that happens when you buy that business is you're like cutting the head off of the animal that is the business and you're throwing it away. And then
That's
you're
right.
becoming the head of the animal. So it's like, when you sign a contract and like in all big bold cap letters, it's like historical performance is no indication of future, it's like that literally is exactly what's happening. Like it is sort of a general directional this way kind of a thing, but it now becomes yours to, improve or not. And I think that especially a lot of the social media, they're sort of like, doing the buy then chill version. It's like, hey, buy a laundromat that requires no work because it's actually real estate, and like hire a manager and then peace out to the beach and just collect checks or whatever. It's like, well, sure. I mean, we can, that actually is a model. And if you call me and say that you're going to roll up laundromats, I just need you to know it's the 2,000th person this week that is telling me you're going to do that. It's not an original idea. It's just easy to sell on the internet. So,
and even still, even if this roll up laundromats, what about the laundromat that went on fire last night? What about the one that just was vandalized in the other? Like, there's no such thing as a business that runs itself.
No, I mean, no, there's not. And I really look at this as active. Like, this is a very active game.
Yeah.
You can get passive, you can get there, but it's sort of like getting a job at Microsoft and being CEO at the same time. Like, it's just like you have to like work there for a while. You have to like do things in a career before you're at the top. Right. Yeah. So it's no different here. So the thing is, when you buy a business, even though it's active, you're getting yourself in the right lane, but you still have to build your career in the right lane. Right.
That's right.
Yeah. And so by the time, like I now have a business that I bought 10 years ago, there's now no debt on it. And I do have a manager in place, and I work as like the chairman. Right. We've got a monthly meeting, and we meet in person quarterly, and that's what's going on, and like I'll even admit that I'm considering selling it because I'm not active in it anymore. Like, I don't know what's going to happen. So being an absentee owner is just sort of like stacking risk on spinning plates, right?
Yeah, right.
Your question was, who does well after they buy a company?
That's right.
I'm going to say three things, okay? One, it's someone that buys an eternally profitable business, which means that it's going to be very low growth, but just cash flows consistently. I want you to think like, corporate window washing, maybe, commercial cleaning, maybe, snow plowing, like this kind of thing, right? Pool cleaning, whatever it is, like just something where like the growth year over year is going to be like zero, but like I've got a lot of downside protection.
Yeah.
Number two is going to be the person that is able to correctly align what it is that they bring to the table as a CEO with the opportunity that the business is providing. Okay. So take, for example, I'm just going to say a hypothetical. I'm really good at, building direct sales, B2B sales teams. And I find a business that, is really tuned in terms of consistency of delivery of product and like has all of the right people on the production side, and really the next step is we're just primed and ready to scale. And that's what I bring to the table because no one else had that skill set in there already because there was only like 24 people that worked there, right? Or whatever. And then the last one is going to be, whoever can sort of minimize the J curve, right? So, and I think this is ultimately where you really start to understand that this is an entrepreneurship practice, which is the J curve means like every single company I've ever bought ever in history, which is a lot at this point. Every single year, the year after I buy it, revenue is lower than the year I bought it. Okay. Yeah. It doesn't scare me. I anticipate it. I don't even necessarily model it. I do model it myself. I stress test everything, but it's like you just like, for whatever reason, like you just know, like sometimes you can look at it and be like, oh, this is the best year they've had in 25 years of business. And that's why they're going to sell, like it's not hard. Like things just kind of fall into place when it's a good time to sell. And it doesn't make me scared because it's sort of like, yeah, they're primed out, which is why they're going to sell it. Duh. Like they need a reason to sell. And like, this is a good year for them to sell. Guess what? I want the asset and I'm going to own it for 10 years, right? At least, or whatever, 7 to 30, whatever it is. So when you get in there and the J curve obviously means I need to reinvest in the company to build, whatever's happening next, in the business. And so if you can leverage your own sweat rather than your own money or use them in a coincided kind of way to minimize the downside needed for the upside.
Yeah, you're alluding to the person who's most aligned with the business itself and is willing to fully immerse themselves, provide that, like get in there, roll their sleeves up and get freaking involved.
That's right. That's right. So when I bought the printing company, I knew that, offset book printing was stable, if not clearly starting to decline. This was 2006. But what was happening was really interesting. There was this little company that sold books online and nothing else. And it was called Amazon.com, right? And Amazon.com, if you remember, was just a bookstore. What they really were doing was they were providing an avenue for self-publishing that had never actually occurred before. And so new titles were exploding. And what happened was it was all an instrument of, there's something called digital book printing, which is essentially not ebooks, digital book printing, which is like exalted Xerox machines, okay, for commercial use. So I bought the company, and then within a year, I knocked down a bunch of walls in the pre-press area, which was now kind of outdated, and I signed leases on 3 printers, and then I bought a small bookbinder, and all of a sudden, we just went to all of our customers and said, listen, all of those titles that are out of print because you feel like you need to print like 5,000 of them to get the per unit price down that you make money on the unit, okay? But now they're out of print because you don't have enough demand. Give us all of those.
Wow.
And so I put that together, and then I walked out to about 125 of our customers, and within 18 months, it was, a quarter of our business. It was like,
wow.
Yeah. And so that's what actually led to me being able to keep revenue the same during the Great Recession and during this major, there was like 37 printing companies a week going out of business.
Wow.
It was a terrible time, and it was like,
and here you are growing.
Yeah. Well, we were flat anyway. And
you're keeping your head above water.
Well, revenue was the same. And we had higher margins on the digital stuff, which was interesting. But like, I remember, I would meet up with my banker once a quarter, just because these were the good old days when, like, banking was still kind of like valuable. Yeah. And he would buy me a steak sandwich, and so I would also just do it so I could eat.
Yeah.
And we'd go out there, and I remember I would always take my financials and just show him right at the beginning of the conversation. And it was like year over year we were flat. And I just remember him saying, like, well, flat's the new growth model. And he threw his head back and laughed, and then we ate steak sandwiches. And I was like, okay, like, if that's what we're doing, like. So it was a different time. And so what's the point is that, like, it didn't cost anything but, some leases and some effort to completely redefine the business, and
amazing, isn't it?
Yeah. And so, I was able to limit the J curve because I didn't need to go out and, invest like $2 million in some kind of infrastructure. It's just all about get to work, use your shoe leather and go,
And this is the perfect time for me to jump in.
Okay.
There's 2 parts to this. The book is called Buy. A lot of people spend most of their podcast time, as we have just done, on the buy side.
Yep.
But then it's called Build.
Yep.
Buy, then build.
Yep.
It is my understanding. You've got all of these businesses that are being sold. Just drive down the road. I do it with my kids. You got the dry cleaners. You've got the food store. You've got this. You've got that. You've got the every obscure business. You got the HVAC guy. You've got the irrigation person. You've got the plumber. Everything you spend money on, right, is boring. Most of it is boring. How much money do I spend on exciting businesses is almost irrelevant, right? But the bottom line is that a lot of these businesses, they're being sold because they are boring, and because they are 55 to 75-year-old lifetime entrepreneurs that built these businesses up. We'll just take a dry cleaner, right? The build part, buy then build. You've just told me how you built the book business, right? The book printing business. You physically changed the business model. But I think the lowest hanging fruit is that most of these business owners, Walker, just don't know shit about marketing. They don't know how to market them. So just that in itself, the plumbing company, we just use a plumbing company. Clark's just set up a plumbing company, right? And it's plumber will give his shirt away because he doesn't know the first thing about marketing. Tell me, is the build part, is the super flex, go in, buy a boring business, and then just layer in, hyperactive marketing around it that the previous owner did zero of?
So, yes, and there's different ways to do this. And I believe that, ultimately today, we look at, the iPhone, and it's not a phone. Remember the phone? It's not a
Yeah.
phone at all.
Yeah.
It's like software and hardware combined to build
Yeah.
something totally unique. Tesla is the same way. It's not a car. It's like
Right.
it's both a car and a computer. Like it's this. And so I actually think that, sort of two answers. One, looking at, what I would like to see, the biggest opportunity over the next, say, 5 years is buying the infrastructure of these old economy businesses and really introducing and hammering in the new economy models.
Yep.
And so it could be as simple, to your point, as like, okay, we have no reviews on Google. We need to change that starting right now. And now we're going to do online marketing. And now we're going to, maybe we go out, and Chris Hoffman has a following on Twitter now, and he bought an HVAC company. Go start a following talking about, smart shit or whatever. I mean, I talked to Chris. I know Chris well. He's here in St. Louis, and like he did a lot of work before he even started talking. So please, guys, go do it first before you start talking, please, for the love of God.
Take 14 years to write the book.
Yeah, exactly. Yeah, and so so there's online marketing. And then I think the big one that obviously is going to come out that seems to continue to just be like this Sistine Chapel moment of almost connecting but not quite there is AI. Right.
Course.
And so, so of course, right. So it's like, we're going to have, AI running the books and dispersing the trucks and, running the accounting and, doing the customer service and scheduling and whatever. And so I think that it's also like, on that point, let's just say that I think that business ownership might actually be the single safest thing out there because of all the people that are going to probably lose their jobs because of this. I did a talk a couple months ago, and I really was just sort of like, all right, look, like I was talking to this very elevated audience, and they really were people that, had, already sort of reached a certain amount of wealth in life, and they were paying a lot of money for, frankly, deals that I could give them for free, but whatever. But whatever.
Not your business.
So, yeah. And so, I talked to them like, look, like if you really reverse engineer the people that have just gotten extreme outsized returns, okay, what they do is they just right back to this J curve. They buy bigger, and then they reinvest heavier, right? Back to the entrepreneurship thread, okay? Like it's like, and what happens is they ultimately build three engines, okay? And the first one is the leadership engine, okay? Kind of to your point. It's like, hey, okay, we're going to, and I don't want to sound like a, Manhattan banker when I say this, but like, I'm not going to bring in like institutional leadership, but I'm going to bring in like more professional leadership. Like who's done this before? And let's bring in leadership that mirrors where we're trying to go, right? Instead of like, hey, I'm just going to stay, a $4 million, was your example? Dry cleaning company. And
It could be plumbing.
Plumbing. $4 million. So if I have a $4 million plumbing company, because a plumbing company could very much be $4 million. So it's like a $4 million revenue company. That's the team. But like, if I really want to bring in like the person that can really lead this group to a different thing, it might not be me, right? But like I can engineer that deal and invest in that person and probably give them some equity and, invest, hundreds of thousands of dollars per year to bring them in. And now we're going to expand to multiple cities, and we're going to put SOPs in place, and we're going to create a training program, and we're going to bring in guys, right out of, wherever, and we're going to train them up, and we're going to have a very clear program on how they increase their own pay, because people they don't want to wait like they used to. Not that they ever did. It's just that now, it's like, I need to know what I need to do today to get 75 cents more on my paycheck next week.
Right.
Like you start creating these kinds of programs and all of that. And then you weave in the strategic expansion that goes with it. Right. And so whatever that means, but it's like you've got these three engines of, the capital deployment and the leadership enhancement and the strategic expansion, and all of those together, are the thing that really elevate the whole machine. Now, I want to be very careful for anyone listening to this. I bought my first company when I didn't have two pennies to rub together. And I put I always say, like, please don't run out there and try to buy a company with no money. Like if you put skin in the game, all of a sudden the C's part. If you're like, oh, I saw on Instagram, I can just use 100% seller financing and put no skin in the game, and don't do that. Like just stay at work. Like please go go get a job until you have 100,000, you know, in net worth to do this. And so you need to put money in, you need to put your life in, and you need to go take a big personally guaranteed loan. Now, once you do that, you're going to make $1 to $5 million bucks. Okay. Just by, you know, bootstrapping your acquisition. Okay. What I just talked about is, you know, really for people that, you know, have moved farther along in their career or in their skill set or in their wealth, that are able to actually go out and now, you know, potentially buy, you know, a 15 or $20 million, you know, what, you know, something with 2-3 million bucks minimum in terms of adjusted EBITDA coming out of a business already, right? That is now primed to launch in a different way.
I want to make sure that everyone heard exactly what you said.
Thank you.
You only get to hire the skill. You only get to bring in the leadership. You only get to bring in the, you know, the high level marketing and, you know, implement the new AI capabilities if the company is making enough money to pay for these things in the first place.
That's correct. That's correct.
I have an analogy, Walker, that's very similar that we beat on about here in the real estate world. So many investors will start off with buying some cheap C-class stuff with quote unquote higher cash flow because it appears it's manageable. Oh, I bought this thing for 100 grand, but it is this case. People come in and they start buying these cheapo properties and they always live to regret it. But look, people start off buying business and they take the cheapest business they can buy, and then they end up buying themselves a job.
Interesting. And there's nothing wrong with buying yourself a job at all. Like it's literally the best way to get started, I believe, right? You know, and people want to talk about how it's not bad. The most experienced traditional search fund investors always encourage their searchers in this way. They say, find the absolute best business you can find and be prepared to pay a lot for it.
It's just, it's a lifetime of experience. You see where traditionally the success is. And in real estate, the success is in higher value, higher, better locations. Maybe the cash flow is not so high, but it's where the profits are. They're in this AAA type of product. And you're just alluding to the fact that when you go out and buy a business, do something similar. Don't buy something that's failing unless you can turn it around, unless you've got a particular skill set.
So I think that number one, you're right. And number two, I think that what you just said will make most people miss their opportunity. And what I mean is that real estate is very developed, right? If I wanted to make a video that would get a lot of clicks right now, I would say something like, you know, 99% of businesses aren't worth buying. Here's the 10 reasons why they all suck. Okay. And why everyone's lying to you. You know, that's a great video. I should go make that. But here's the point.
We're already going to post that.
Yeah.
We've got it now.
But here's the point is that, like, when I was, you know, first talking to my editor, Tucker Max, he was like, all right, you know, who's your target market? I'm like, all right, listen, I already know how this conversation is going to go, Tucker. Like, they don't exist right now. Starting a business is what makes an entrepreneur. Like, what you're saying doesn't make any sense. And I'm like, well, do you know, like, EO, like Entrepreneurs Organization? It's like them, but like without their business. He's like, that makes no sense. I'm like, you know what real estate investors are? And he was like, yeah. And I said, you know how, like, before Rich Dad, Poor Dad, they didn't like gather? And like now we say real estate investor, and you know what that is? I was like, that's my market, and they don't gather yet. And I could tell he just was looking at me like I was another author that like didn't know what his target market was. Like, he didn't quite get it yet. You know, he got it by the end, you know. And then ironically sold his company to a couple of acquisition entrepreneurs who read, buy, then build, who I was just with. And so anyway, but the trick, I think, is that, and I mean, no disrespect to, you know, business brokers or anything out there, but the market is, you know, completely unregulated. And business brokers, you know, Clark, kind of what you said earlier, it's almost like a real estate agent is all of a sudden going to sell you, you know, a manufacturing company. And it's like, okay. And it's like that, you know, that no one understands how to package these companies. They don't understand what's important about them. They don't really know how to put like a real deck together. And the sellers don't have, you know, any kind of professional reporting because they don't have a board of directors. They don't have people they have to report to. Everything's in their head. And like, I love these buyers that, you know, they're like, would you please send me, you know, a like cost accounting by SKU by month over the last 5 years so that I can run a regression analysis and figure out the predictive, index of the revenue. And I'm just like, dude, there's no predictive index of the revenue. Like, this is just go fucking work. Like, and you push, that's it. Anyway, and the seller's like, what are they asking? What are they asking for this for? It's just like, it doesn't make any sense. I'm like, I get it. And so there's a disconnect between really being able to pierce through and get the information you need and being able to see what's actually there. And so what I'm trying to say is that the business model of business brokerage is sign as many sellers as you can and launch to market with half-ass incomplete information that is non-standard and non-regulated and no one anything. I love those opportunities because most fair weather buyers, which most buyers are, will not actually be able to pierce through to that broker, prove themselves quickly, and be able to gather the information that no one else can gather because the package sucks. So it could be an A+ location.
Yeah.
And you can't tell because the package looks like a piece of shit and it's sitting on Biz Buy Sell or wherever else.
I got it.
By other pieces of shit. And like, I have so many people in Acquisition Lab that were just able to find a deal and like uncover like, oh my God, like here's this. And I was just like, whoa. And like, you can't see it because it just looks terrible. So it all looks so bad, but when you spend the time to find and engineer the deal in every business that's listed for sale, that seller is ready to sell. And everyone spends a lot of time looking for off-market deals because we learned it in real estate. Number one reason why off-market deals fall apart is because the seller never wanted to sell anyway.
Go behind the scenes with Burn Your Boat's Wealth. Follow us on social media and YouTube for unreleased clips, bonus videos, and more content from David Shaw and Clark Lunt. Search Burn Your Boat's Wealth everywhere you are: Facebook, Instagram, X, TikTok, and LinkedIn.
Can I tell a quick story while we're on this? It just occurred to me. So after Buy Then Build came out, so I lived in London for a little bit, and it was one of these where Tantor Media reached out to me and wanted to buy my audiobook. And I said, okay, I will do it, but I know a bit about the entertainment industry. And what happens is a lot of times you can get the money for a project, but only if there's some certain people associated with the project. So I went back to them and said, look, I looked it up, and there are these 3 people who have all won more awards for, spoken books than anyone else. And as long as you can get one of those 3, I will sell you the rights to my book. And they wrote back and said, Walker, all of those you've picked are British, and your book is squarely American. We disagree. And I said, good save. Can you imagine if Buy Then Build was spoken in British, English accent? I
can, but I wouldn't take it as seriously.
Right.
That accent. Walker, take it. We're going to be respectful of your time, my friend. I appreciate it. And tell us a little bit about what's next, man. We've talked a lot about Buy Then Build. That's one of many, many things you have going on in your world. Kind of take us out on what's next for you.
Yeah.
And also too, we want to make sure that anyone listening that is probably has that mindset of getting started, obviously going and reading the book Buy Then Build is the first step, but then the Acquisition Lab. So how can they find out more about it? But tell us first, what's next for you personally?
So I've been investing in the private markets, right, since probably 2013, right after I sold my first company. So I was buying, so that I could manage actively, but I was also investing in other companies in real estate and eventually credit funds and other private assets. A lot of actually film and entertainment, video games and stuff as well, IP. And, what happened was in February last year, I wrote an email to my email list, which sort of was, we send an email out, at the buythenbuild.com address to, about 54,000 people every Sunday. And we've done it for 5-6 years. It's like 2,500 words. It's like a mini chapter every single week. And like, we don't ask for anything. We just sort of say like, hey, here's a lesson, here's the thing, whatever. And last February, I sent an email that said, listen, I know I'm the Buy Then Build guy, but like, surprise, I also invest in real estate. And like, here's actually my A team. And we have this great project that I'm personally investing in. And I've got more money with these guys than anyone else. Like, I work with them as a GP in some projects. This one I'm not. And I said, so I'm investing my own money. And if you guys want to join us, it's about $1.35 million.
Yeah.
And full disclosure, if you come in and we fill this, they're going to move me to the GP side. So I'll make more money than you. But even if you don't, I don't care. I'm already in it.
Yeah.
And we raised $4.5 million in 4 hours.
I remember that email. I remember getting that.
Okay.
I remember that email.
Yeah. It was the best thing I ever wrote. Just kidding.
Yeah. I just remember noting at the time, I remember like Walker's pivoting.
It's not a pivot. It was an expansion. It's an expansion, right?
Okay.
Right?
It wasn't a pivot. You're exactly right.
Yeah. So
Walker is expanding his offerings.
It's the difference between being active and passive. And a couple of things always happen, which is for years, everyone was like, Walker, what are you investing in? What's the business you're buying? What's the whatever? And so when that happened, I kind of had this big aha moment. And now, looking back just over the last 10 months right now, we raised another $20 million for a manufacturing facility in Dallas. We've got, 700 oil wells. We've got a ground up development, largest mass timber building in the world. We've got credit funds with 8 assets in it. We've got, all these things that I'm putting my own money in. And I've just got this crazy pipeline. And so what's really awesome is that I'm realizing that, this is what people want from me. They're like, Walker, where's the offering that's like, hey, I'm Walker Deibel. We're going to raise a bunch of money and go out and buy, 20 different small businesses and just grow them all. And the problem with that is that I'm continue to work on it. But the truth is that, at first glance, it seems like it's going to be awesome. I mean, I wrote this book. I'm out there doing it. I'm doing all these things. But the truth is that once you scale that, I mean, this is a truly entrepreneur-centric model, period.
Right.
Okay. That's why I like it. That's why it makes so much sense. The minute you do that, it becomes an investor-centric model. And what do the investors own? The investors own 20 single-engine aircraft flying 1 mile off the ground with all brand new pilots. That's literally what everyone's asking me for. And I'm like, that takes a lot. Like we can do that, but and I might be able to get it done and I'm working on it, but I'm very, very specific about how that would go down. And the truth is that, based on the J curve and everything else we just talked about, if we're going to raise money and put in professional teams and really grow something that's like to 100 million, the best way to do it is by buying much larger institutional assets.
Yeah.
And, I've got a concept vehicle that I call Wealth Stack. And it's just sort of like, do you want, cash flow or appreciation or asymmetric upside and, all the rest of it. And it's just, so it's all about building a portfolio in private assets, right? Which you guys do as well.
Yeah. What you're saying is like, what got you here won't get you there.
Yeah.
Right?
And it's also in life, you have your job and you invest in the stock market, right? But the truth is once you're in the private capital markets, you have a business that you own and operate, and you invest in private assets.
Got it.
Like it's the analogy. That's it.
It makes total sense to me.
Exactly.
So
that's called Build Wealth. You can go to buildwealth.com if you want to get access to our deals. It's so we've launched a new newsletter called Wealth Stack Weekly. I've got the M&A insights that we launch every Sunday. So what's next for me? Guys, I'm having a lot of fun. It's just sort of like, I feel like ultimately what I'm looking for is I want to build a community of like 1,000 investors that want to invest like 50 to 250,000 1 to 4 times a year. And then we can just go out and raise $5 million every single month and just take out these assets and J curve them to the next level, right? Like that's what I think is just really going to take, buy then build to sort of like really and allow people to participate together. Right. So you take all these people in acquisition lab and just, say like, how do we actually work together and build our own damn family office? That's what I think is so cool.
You're not wrong. We buy businesses. So what do we do with the money that we make from businesses? We invest it. And so this is just a natural, like you've already built the credibility with the people who own businesses who are now making lots of money and they want to do more stuff with you. It's so obvious.
Yeah. Well, thanks. It wasn't obvious to me, but it happened. And I'm slow. I go slowly, I like to go really slowly and get things right. So hopefully that's what happened. But I almost bought a company earlier this year. It was about 17 million. I'm not going to buy it. But like the last offer I made on a business was, just to throw this out there at closing of the podcast, the last offer I made was 180 million. I made that offer.
Wow.
Yeah.
Wow.
And they couldn't take it because it was too low of a multiple, but like it was a 7.25, right? But it was fair. I mean, it was a fair offer. They just couldn't take it. You know, the thing is I'm now in a position where I can do that. And so,
Yeah,
you know,
amazing.
buying a $2 million business and owning it for 10 years is like, I've been doing that for 19 years.
Right.
Like
Yeah.
I can do that in my sleep, you know, and it's like, I've done it so many times that, you know, I said earlier, if you want to make $1 to $5 million, go and buy a business.
Yep.
Period. Right. That's it. But what you're saying, David, is like if you want to go from 2 million in net worth to 20 million in net worth, you've got to be in the private markets.
Yeah.
So it's like we can assemble that team and build that together to, you know, just to do it together.
The analogy I'll use is that buying and holding real estate for most people is not scalable. They can handle up to 15, 20 deals, maybe 30, but not 50. You know what I mean? You can't own 50 and manage 50 single family homes yourself. It's not scalable. You're just going to be running around going crazy. Well, what you're saying is you need to hitch your wagon to a bigger boat that's not going to look like this idea of owning 20 businesses in a small fund. Walker's Fund A and Fund B.
Right.
You can't grow like that. That's what you're saying.
I think there's a ceiling, you know. Yeah, I mean, there was a time in my life where I couldn't imagine how I was going to get $1 million, and now it's the numbers just there's zeros on it. So what I haven't shared this yet. I'll say it right now that my number one real estate partners here in St. Louis, they roll up and develop entire neighborhoods. Like it's not a lot of one-off projects. It's rehabbing entire neighborhoods. And like, it's a lot of fun. And I really have spent a lot of time in the room with them. And essentially, you know, they're about 150 million AUM right now. And if we just continue to build out what is already funded, you know, they're going to be about 350, 400 million. I'm actually buying in to the partnership level. And I'm going to be in a position here in short order where I have multiple millions of dollars invested in this company. And what's happening is I'm basically buying, then building the real estate company.
Yeah.
Right. And that's going to become the only real estate that I raise for because I'm in the company. And like, my brother-in-law is working on one of our assets. And like, it's like, okay, this is my team. Let's go. So I'm buying right into it and we're going to grow. I want to grow that to $1 billion over the next 5 years. That's AUM. And that's just the real estate side. But so that's what I'm wanting to do. Because now it's like, now we can all go together and rehab this whole neighborhood and like go like that.
I think a lot of people listening to this can feel the passion through the microphone. You know, like I can feel your passion, like it's contagious, right? It's like, hold on, what is Walker doing? Okay, he's gentrifying entire neighborhoods. Like that sounds pretty cool. Maybe I should come along for the ride. So, you know, I feel your passion, my friend, and I feel it's contagious. Walker, with that being said, man, we could spend another 2 or 3 hours going on to the next thing that you have going on and the next thing going on. Unfortunately, everyone on this planet has ADD and we lose our attention span after 12 minutes. So we'll leave it at that. And Walker, it was buildwealth.com, right?
Buythenbuild.com, acquisitionlab.com, buildwealth.com. I've got a YouTube channel with 300 videos all on buying small businesses. Please check it out. Don't forget to like and subscribe. Follow me on LinkedIn, all the rest of it. Thank you so much. This was great.
I cannot wait to meet you again sometime soon. Okay.
Let's go skiing. Thanks, David.
Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. And if we reach more listeners, we will have bigger and more interesting guests. So don't miss the show. Please go ahead and subscribe so you don't miss the next episode. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.